Ever look at a giant like Alphabet, Google, ticker GOOG, and just wonder what's really going on under the hood?
Yeah, beyond the headlines.
Exactly. So we've got a recent stock analysis report, plus insights from their latest earnings call. And today, in this deep dive, our goal is simple. Cut through all that data and pull out the absolute key takeaways for you on Alphabet's financial state and where they might be headed. Quick and focused.
Right. We've basically boiled down this stock report, price targets, rankings, financials, and the crucial bits from their earnings discussion. Think of it as your shortcut to the important stuff.
Okay, let's jump right in. Where's the stock at? This report had GOG closing at $163.85. And the analyst target price is $180.16. That suggests, what, about an 8.7% potential upside from that closing price?
Yeah, and they also note the 52-week range, where it's been trading. $142.66 on the low end, $208.07 on the high.
What really caught my eye, though, is the wide economic moat rating. What's behind that? That sounds significant.
Oh, it is. And it's fascinating why. That wide moat, it really comes down to their dominance, almost like a utility in online search with Google Search and online video with YouTube.
Right.
Think about the network effects. More users mean more data, better results, which attracts more advertisers, which funds more content or features, attracting even more users. It's this powerful cycle.
It's all feeding loop, basically.
Exactly. That, plus their data advantage and how their ad auctions work, it makes it incredibly hard for anyone else to really compete head-on. Though you do wonder, with AI evolving so fast, could someone eventually chip away at search? That's maybe a longer-term question.
A valid point. And it seems other analysts agree on the potential. The report mentioned the average price target over the last 6 months is actually higher, around $205.
Right, even more optimistic there.
And this specific report felt that the price back then, $164.25, looked like a decent entry point compared to their own fair value estimate of about $180.33.
So the general sentiment, at least from these analysts, seems pretty positive about Alphabet's value proposition, tied back to that durable competitive edge, that moat.
Okay, let's pivot then to how they actually performed recently. Q1 2025 financials. Consolidated revenues hit $90.2 billion. That's up 12% year over year.
Yeah, or even 14% if you adjust for currency fluctuations. Strong growth.
And it wasn't just one thing carrying the load, was it?
No, not at all. The earnings call really stressed that growth came from multiple areas: Google Search, YouTube ads, their subscription platforms and devices unit, and Google Cloud, all showing double-digit growth.
That's impressive breadth.
It really is. Shows the power of their different pillars.
And profitability looked good, too. Operating income jumped 20% to $31 billion.
And the operating margin expanded, too, up to nearly 34%. That's a solid increase, about 2.3 points higher than the year before.
Net income saw a huge leap, 46% to $34.5 billion. But there's a catch there, right? A big unrealized gain.
Yeah, that's important context. They had a significant unrealized gain on equity investment included in that number. So while the headline net income looks massive, you need to be aware that part isn't from core operations.
Right, it's more of a one-off, potentially volatile thing.
Exactly. Something to watch in future quarters, but the underlying operating income growth is still very strong on its own. EPS was also up significantly, 49% to $2.81.
Okay, let's break down the segments a bit. Google services, that's the core stuff, like Search, YouTube, Android, etc. Revenue grew 10% to $77.3 billion.
Solid growth there. Search ads up 10%. They mentioned strength in financial services like insurance and also retail.
And YouTube ad.
Also up 10%. Apparently driven a lot by their direct response formats. The ads pushing for an immediate click or purchase.
Got it. But the real star within services seems to be subscription platforms and devices, up 19%.
Yeah, that's a big jump. Mainly driven by more people signing up for things like YouTube Premium, YouTube Music, and also Google One Cloud Storage. Subscriber growth was the key there.
So core ads are strong, and subscriptions are growing even faster. That sounds like a healthy mix.
Definitely. It points towards, a more diversified revenue stream within their main services unit.
Now, Google Cloud.
Yeah.
This looks really strong. Revenue jumped 28% to $12.3 billion.
Huge growth. But what's maybe even more important is the profitability story there.
Tell me about it.
Well, operating income for Cloud hit $2.2 billion, and the operating margin went from 9.4% last year to 17.8% this quarter. That's a massive improvement.
Wow, almost double the margin. What's driving that? Is it just scale or?
Scale is part of it, but the earnings call highlighted really strong demand for their AI offerings within Google Cloud.
Yeah.
Businesses are turning to them for AI infrastructure and tools.
So AI is not just a product feature. It's driving cloud adoption and profitability too.
It seems so. Suggests they're successfully selling higher value AI services, not just basic storage and compute anymore.
Okay. And then there's the other bets segment. Still losing money, right?
Yeah.
About $1.2 billion operating loss in Q1.
Yeah, that's typical for other bets. These are the long shot, moonshot projects like Waymo, their self-driving car company. Management did say they're making progress, particularly mentioning Waymo.
Any hints of other bets getting closer to becoming real businesses?
Not specifically highlighted in this report or call summary. Beyond the Waymo progress mentioned, these are generally very long-term plays, so patience is key there.
Right. Let's focus on AI then, because clearly that's a massive priority across the whole company. They talk about a differentiated full-stack approach. What does that actually mean?
It means they're involved at every level. The foundational infrastructure, like the specialized computer chips.
The TPUs they develop in-house.
Exactly, their tensor processing units. They mentioned their 7th gen, called Ironwood for inference, which is running the AI models. Plus, they're also aggressively adopting NVIDIA's latest chips, like the B200 and GB200, being first in the cloud to offer them.
So covering both custom and standard high-end hardware.
Right. Then there are the AI models themselves, Gemini 2.5 Pro, which they boast as top-ranked, Gemini 2.5 Flash, Imagen 3 for images, models for voice, music, even robotics and health AI research like AlphaFold.
A whole suite of models.
It's a very broad portfolio, and the final part of the stack is integrating these models into their products.
And that integration seems really pervasive now. Gemini is apparently in all 15 of their products that have over 500 million users.
Yeah, that's the key leverage point, taking advanced AI and putting it directly into Search, Assistant, Android, Pixel phones, Workspace, basically everywhere.
So they get massive real-world usage data back to improve the AI further.
Precisely. It's a huge advantage. Upgrading Google Assistant to use Gemini is a prime example.
And how's AI changing search specifically? They mentioned AI overviews.
Right. These AI-generated summaries at the top of search results, they claim these now reach over 1.5 billion users monthly and are actually increasing commercial queries.
Interesting. So it's not cannibalizing ad clicks, maybe even boosting them?
That's what they suggest. And they're experimenting with an AI mode for search, handling longer, more complex questions. So search itself is evolving significantly.
And in cloud, we touched on it, but the AI demand is strong there too.
Very strong. Their Vertex AI platform gives businesses access to over 200 AI models, both Google's own like Gemini and models from other companies. They also highlighted AI agents, which are like specialized AI tools businesses can deploy.
Okay, looking forward then. They're planning some hefty spending, right?
Yeah.
Capital expenditures around $75 billion for the full year 2025.
Yeah, that's a big number. Primarily for building out that AI infrastructure, data centers, servers, chips.
And that level of spending could squeeze margins a bit in the near term because of depreciation.
Correct. As you build more stuff, the accounting rules mean you spread that cost over time through depreciation, which hits your GAAP operating income and margins. So that's a potential headwind they flagged.
Any other near-term challenges mentioned?
They noted they'll be comparing against really strong advertising performance from the previous year, which can make growth percentages look a bit tougher, and a small impact from some changes to import rules, the de minimis exemption, plus, the usual ongoing regulatory scrutiny, especially out of Europe.
Always a factor for big tech.
Always. But management stressed they're also focused hard on efficiency and productivity gains to try and offset some of that investment pressure on margins.
And the overall long-term picture still sounds positive from their perspective.
Very much so. They emphasize their AI leadership, the global infrastructure, deep research capabilities, and importantly, their track record of actually building huge new businesses like they did with YouTube and Google Cloud.
That ability to scale is crucial.
Absolutely. It gives credibility to the idea that maybe some of today's AI investments or even other bets could become the next major growth engine.
Finally, let's talk shareholder returns. They seem committed here.
Definitely. In Q1 alone, they bought back $15.1 billion worth of their stock.
Wow.
And paid out $2.4 billion in dividends. Plus, they just announced a 5% increase to the quarterly dividend and authorized a new $70 billion share repurchase program.
So funneling significant cash back to investors.
Yeah, it signals financial strength and confidence in future cash generation. It's a big part of the investment story for many people.
Okay, so let's try and wrap this up. The big picture seems to be Alphabet's showing really solid financial health, core businesses are growing nicely, cloud is becoming a profitable powerhouse.
Mm-hmm. And AI is just woven into everything now.
Right. That massive AI investment is key to the future, even if it causes some near-term margin pressure from things like depreciation.
Mm-hmm.
But the long-term potential looks strong, backed by that AI leadership.
And bolstered by those significant returns to shareholders through buybacks and dividends. It's a company firing on, well, most cylinders, while betting big on the future with AI.
This quick look really shows a tech giant in transition, pushing hard on AI while still delivering strong results today.
The AI integration across that huge ecosystem is really the dominant narrative right now.
And that leads to our final thought for you. How will this aggressive AI push across Alphabet's vast landscape, reshape not just its own growth, but the entire competitive field? Yeah. And then thinking about those other bets, what new ventures fueled by this AI focus might eventually follow YouTube and cloud to become the next major pillars of the company?
Lots to consider there.
Indeed. So if you found this focused deep dive useful and you want more analysis like this, please do subscribe to the channel and make sure you hit that notification bell.
Yeah, your support really helps us keep digging into this stuff and bringing you these insights.